Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. It's simple. From now on, you may no longer get the kind of discounts you did online for mobile phones, books, clothes and other products that you've been buying. Now, this is because new regulations have been issued by the Ministry of Commerce for e-commerce firms. They say that the government will allow up to 100% investment in online marketplaces that offer their technology platforms to sellers. But these firms cannot influence the prices of goods sold on their websites, and that's Flipkart, Amazon and so on. Now, there are two parts to this issue. First is that the rules themselves and who will they affect or benefit. And second, does this make the level playing field more level for some, and particularly the brick and mortar guys? And more importantly, if so, is that the way to go? To discuss this, I'm joined by Mahesh, Murthy, partner Seedfund. And I'm also joined by CA Gupta, tax partner Deloitte, Haskins and Sells, and Paresh, tax partner Ernst & Young. So let's get the principle out of the way. Mahesh, why don't you start off? What does this mean fundamentally?
So to me, broadly, it means a big lobbying win for the brick and mortar industry. It seems a little ridiculous that today that a big bazaar has a right to discount as it wants in India, but an Amazon and Flipkart don't have the right to do so. To me, this is an extremely non-level playing field. It's like stacking the playing field in the hands of the Indian contenders. Also, it's extraordinarily anti-consumer, right? The fact that now today you're telling the consumer that I'm sorry, you're not going to be able to get discounts from people who are willing to give you discounts just seems a little ridiculous and status to me. I do think that this entire thing about the level playing field is a bit of a misnomer, because who is selling on the marketplaces? It's the brick and mortar stores that are selling on the marketplaces, and by actually in some ways handcuffing them, and there are more than 200,000, 300,000 brick and mortar stores that sell on these online marketplaces. It's an extraordinarily anti-brick and mortar move. So the only people it has helped actually is a really large brick and mortar stores, i.e. Big Bazaar, right? It's not helped any small brick and mortar stores, and it's absolutely not helped the consumer. That's really my read.
Right. So let's get the technical part out of the way now, Paresh. So there is an FDI regulation. Now this is all only concerning companies that have foreign investment. Otherwise, there is no restriction. Am I right?
That's right, Govind. So if, let's say tomorrow, Govind, you want to start a company, a marketplace, none of these regulations apply to you.
And I can discount.
You can influence the price, you can give coupons, you can give cashback, whatever you want. So in a way, this is also discriminatory in a sense for companies which want foreign money and do this expansion.
Right. So if we were to say that we have guidelines today already for direct investment and foreign direct investment in retail, is this in some ways the government trying to be fair? Let's forget about the lobbying part, but is this the government trying to be fair to ensure that the guidelines apply uniformly to everyone?
So two things. One, I think we always believed that marketplace was open to FDI. There were no conditions. In the garb of clarity, in fact, they put conditions. And there is a precursor to this. The whole Delhi High Court, the whole brick and mortar, the whole RAI, Retailers Association of India writ, and the whole notices which were issued. The response from the government at that point of time was that we don't have any model called marketplace. So in that hurry to make up and bring clarity, they have brought it, but they have put ridiculous conditions, and it will be interesting to see what do you really mean by influence the price. Now the seller is actually deciding the price, but can the marketplace not, as a customer acquisition initiative, actually have some cashback or volume discounts which is not linked to the product? Imagine that these players have already established themselves, but what if today Paresh Parekha or Govind wants to start up with a foreign funds a new e-commerce? And it is these kind of new players who will be actually impacted more, because they will have lesser avenues to attract and gain customers and to attract them on their websites.
But can you? I'd like you to answer the primary question. So what you're saying makes sense, but the primary question still is, from a legal technical point of view, was the government being correct?
I think legally there's hardly anything that one can challenge in any court of law. They wanted to play it safe in the sense that tomorrow, hypothetically, a court should not struck down this FDI in marketplace without any condition. When brick and mortar says that, okay, we have been treated as a stepchild, for us $100 million is the minimum investment to get foreign direct investment, 51% and is the maximum limit, whereas marketplace guys are doing everything what is required in retail except owning the inventory. And interestingly, having said that, some things have gone in favor in terms of clarity for marketplace. You can now actually, as you read, provide logistics services, provide payment platforms, and so
warehousing
on.
and so on.
I'm clear about that, Paresh. I do believe, and I have had discussions with a couple of people, that this actually violates MRTP. It is a restrictive trade practice. It's clearly restrictive trade practice. We are not allowing me to set the prices that I wish, and you're determining the price in the consumer market. And I think somebody somewhere will take it up and challenge the law at that point in time.
So, okay, a different way of looking at it. Now I'm wearing a legal hat. Basically, here, as per the policy of government, a seller is selling to a buyer, customer. The marketplace, which is just a platform, is just a technology enabler. That is how they have positioned it. In that case, all that what you are saying is that a seller can of course decide the price. If a seller decides to give 80% discount, it's all fine. You as a marketplace should not be influencing whether you should be giving 80% or 50%.
So can that be determined easily?
So actually, can I
So practically, I think it's a challenge. I think practically to go back and check each and every price and who is influencing it, because very hyper technically, again wearing a legal hat, one can always have a B2B entity which is procuring from the market and selling at a huge discount to the seller who is on your platform, who can in turn pass on that discount. So there will be major.
Let me get CA. We haven't heard from CA. Yes.
No, so today, insofar as the FDI is concerned, they made a distinction between marketplace and the inventory one. So you can't do any FDI inventory and you can do only in marketplace. Also linked to this will be the question from a tax perspective as to whether how do you tax the seller who is a non-resident. Now today, if you have three buckets, one is a pure resident who is fully taxed, one is global income. Then you have the marketplace entity, which again is an Indian company but will be taxed on its income. Then you have the non-resident part. Now if the non-resident is or the foreign company is entering into a transaction through the marketplace entity, how do you decide as to whether the foreign company is taxable or not? And that's where the rules of permanent establishment come in as to whether is there a permanent establishment being constituted by the foreign company, or if they were to operate directly through a third party vendor. And that's again where the whole issue of maybe we'll come back later on the equalization levy which is proposed, but also the whole BEPS action plan as to whether are you fragmenting your activities in India, and that is the whole.
Which they are, right?
So that depends upon the structure which they are using.
Okay.
So that's the whole thrust of the BEPS action plan, that if you're fragmenting your activities, then they will look at the all activities together to decide whether there is a permanent establishment.
So Mahesh, is this a forced reality check? I mean, let's look at it slightly, if you were to take a few steps back.
So, I think in some ways, to react to Paresh, I think if there's a foreign funded marketplace versus an Indian funded marketplace, it's certainly a monopoly, it's a restrictive trade practice for the foreign funded marketplace, because an Indian funded marketplace can do whatever you want. So, in effect, if I went through 20 HNIs and raised this thing and, got this thing done, we could pretty much go and do whatever we wanted, right? Whether it's a good business decision or bad, that's a different point of view. I have a deeper issue out of this, and to me, that's really something that troubles me a lot more. I think this issue by itself can probably wend its way through the courts, and we'll have to figure out what happens. But the bigger issue is the government really coming in and putting in price controls and cost controls on what is essentially consumer good? The government did that in the case of Monsanto and GMO food, where Monsanto threatened to exit India because its margin was restricted. In this case, the government is pretty much now telling all the foreign funded marketplaces, I'm going to determine how much money you can make. At some point, somewhere in the future, are we now stepping back? This is supposed to be a rightist, capitalist friendly government, and we're becoming far more socialist than even the earlier government, right? So this is extraordinary protectionism, and like I said, it is protectionism not for the small brick and mortar retailers. It's protection. Let's call it for what it is. This is a Kishore Biyani's support bill. Right?
Okay, so we don't have him to respond on that, but anyway, he's been on record.
Digital disruption was the only place where marketplaces were the only forces playing, and in the whole game, consumers were benefiting, either lower price or better facilities. Unfortunately, now government is even entering in terms of regulation.
Right. So
it is unprecedented. Nowhere in the world I am able to think of any regulation where government decides what price or how should things be priced.
So I'll tell you, I think the other offshoot is, if I was an overseas investor and I look at India and say, what, you mean the government is now forcing me to sell at a particular price, forcing me to, manacling my hands in terms of what I can do and what I can't do? I think it's an extraordinary negative symbol out there. Just to support one small, group of very high net worth brick and mortar retailers, the government has gone so far out of its way. I think it has a potential to jeopardize future.
So let me ask the other question then. To what extent are we so dependent on foreign money then? Or can this market not, or can enterprises not go without foreign money, particularly in sensitive sectors as the government defines it?
Going, you like it or not, last few years you see all these e-tailing have grown based on foreign money. Ultimately, to get scale, you need access to foreign money. So I think this practically impacts each and every Indian entrepreneur who wants to scale up his business today, to start with,
You're saying in any area?
he may be able to do it initially with Indian money, but if you want to really take it to the next level, I think you need access to global capital. And if the global capital is ready to burn for customer acquisition cash in India, and consumers at large are going to benefit, which they have benefited over last few years, I think as a policy, government really can rethink why it really wants to stop the party.
Mahesh, color of money?
Yeah, to me, it's also the amount of money. It's not the color of money. I mean, so we've gotten $80 billion in the last few years only in terms of private equity money coming into India. I don't see that kind of money available in India. The LICs aren't investing that. The insurance companies aren't investing that in consumer commerce companies. So what are you?
And nor can you go to an LIC and ask for money. I mean,
what we do at best is we say, okay, fine, we're putting 10,000 crores, but we'll drip feed that 200 crores at a time. So what is 200 crores? It's $30 million. What is 30 million versus 80 billion, right? So essentially what you're saying out here is, are you, now, and at the same time, your ministers have been going out to the rest of the world and saying, give us money, fund us, make in India and so on and so forth. At the same time, you're saying, well, you can't make in India, I'll tell you what price to sell it at. I think this is really a bad lobbying-led decision. It's not been taken on balance in terms of...
no, the government is saying it had consultations with everyone.
I really don't think so. I mean, having been part of understanding the various parts of it in NASSCOM and others, I don't think it had consultations with this part of the industry out here.
But you need to appreciate that all said and done, the sellers on online platform have lesser cost. So naturally, they have that advantage of saving on rentals and overheads. And why shouldn't they give a discount vis-a-vis what is sold at the brick and mortar? Naturally, that discount can be passed on and should be passed on to the consumer.
Right. Okay. So what needs to be done? CA?
No, so point is, in so far as depending upon what the government philosophy is, if they are looking at this philosophy to only encourage, as Mahesh is saying or as Paresh mentioned, to only a limited group of business entrepreneurs, then that's what they is. But the other thing is more on a larger e-commerce thing. Is today, as I was mentioning, is this what we talk is only on buying and selling goods goods as such. But today, if you see the equalization levy, for example, now that's being proposed to 6% on your online advertisement, and they've kept a window open that they can notify any other services. Now, in the report which they had just issued, they were around 13 categories of activities which they were proposing to tax. Now, if they increase the ambit of that services beyond what is only specified as online advertisement, then it's going to be huge again tax implications.
So your concern is the openness of it. I mean, the open-ended nature of it, or the specific?
No, my concern is more from the taxation aspect, that today you are taxing only online advertisement at 6%,
and potentially this could extend.
And potentially this could extend because it's a window open where they say any service which may be notified. So, and they already have listed.
And that in turn reflects a certain approach which you are not comfortable with? Or?
No, that is in the sense approach is because they want to tax the digital economy, and the digital economy there's no nexus.
That's fine, or that's not fine?
No, that's the G20 philosophy.
Okay,
that's the G20 OECD philosophy, that we would like to tax the digital economy, but there's no basis because today there's no nexus approach, and they don't have a permanent establishment. So while equalization levy was not only discussed, India went ahead and implemented
Paresh,
equalization levy.
Paresh, last word.
I think I would say this is unprecedented. The conditions have put a lot of players in a googly. All are in their boardrooms discussing what has happened and how do we react.
Right, but there's also you said that there is some good news in this, right? There is clarity for people who want to come in now.
So it's like clarity is like the bad news was not so bad. Some even had a remote fear that the court may strike down and say e-tailers or marketplace should not even get into logistics and control inventory and control delivery and so on. Fortunately, that has been clearly and expressly clarified. So that's the good thing in the policy.
Right. Mahesh,
everything was fine. I'm not sure what the problem was, right? Everything was fine. Now because nothing was there was no regulation out here. Now in the interest of clarity, they've actually put down restrictions out there that never existed. Frankly, I mean, to me, this is, and the Kishore Bayani Bachat Yojana, and it works for him, it works for a few people, it does not work for the larger economy of India, it does not work for the people of India. I would really, really hope somebody fights this in the court, and I really hope that the government takes a step back on this.
Right. And I hope that by next edition, we hope to get Kishore Bayani in to say his point of view as well. Sure. Thank you so much for joining us. We need to go in for a break. Coming up on the other side, we look at interest rates and whether home loans are falling for you. Stay with us. Welcome back to Policy Watch. Home loans have finally started to become cheaper thanks to a shift in the way banks calculate their lending rates. The Reserve Bank had earlier announced a new formula called the marginal cost of lending rates, which means rates will be decided on the marginal cost of funds. Meanwhile, the first bi-monthly monetary policy review is coming up on April 5th, and there's a general clamor for a 50 basis point reduction. Now, with a lower interest rate regime and a new formula as well, how could life for you, the borrower, change? To discuss this, I'm joined by Shubhada Rao, Chief Economist at Yes Bank, and Debopam Chatterjee, Chief Economist of Zyfin Research. Thank you both for joining us. So, let me start with you, Shubhada. What does this MCLR mean in very, very simple language?
Simple terms, it would be that earlier the base rate calculation used to look at the overall weighted average cost. Here you're going to put a larger weightage to the marginal cost of funds, that is the latest in, and that would reflect latest booked liabilities or so on, and that would help reduce the cost, because the current liquidity context, your shorter end would reflect the lower cost of funds as the money markets are.
And what's the real impact likely to be?
The impact, well, each bank, I think yesterday we got State Bank of India announcing its MCLR across a tenor, so 40-50 basis points is what we see across the tenors has been the easing. I think early days yet, but definitely MCLR will prima facie help in a better transmission. When RBI reduces the the rates, repo rates, that immediately gets reflected in the money market
was this
rates.
a way of forcing the banks to do something that they've not been doing?
It was creating an enabling environment, but at the same time, I would also like to add that we await the liquidity framework which RBI has mentioned about. At the end of the day, where was the transmission stuck from banking sector was, while the repo rates had been eased by 125 basis points, we didn't see about more than 60 or 70 basis points of transmission. The reason being that the banks were grappling with unpredictable liquidity availability, and for banking system to be able to go on to the a more deterministic asset liability, you need liquidity, which is more or less.
So liquidity means cash available to banks in order to
not just cash, the dispensation available. It could be through open market operations. It could be through longer tenor repos.
I'm just trying to make this simple. So, to someone who's watching this, this would mean that banks should have access to more capital.
Yes,
so
banks should have more liquidity, so that they know that whatever the rate cuts have been administered by the Reserve Bank, they have the ability, because they may have booked liabilities at a higher cost. So in any case, the whole transition period is a long-term process. In addition to it, if I have a confirmed liquidity, then the banks have the appetite and the ability to pass on those rate cuts to the borrowers.
Right. Okay. Debopam, so how are you seeing this? Are you seeing this final transmission happening? I mean, me as a home loan borrower or a car loan borrower actually feeling that my cost is going down?
Well, as a new borrower from 1st April, if you take your loan on 1st April or after that, then definitely your EMIs are going to come down. And MCLR is a fantastic new way, and because of the mere fact that it is marginal, and marginal means anything which is recent. So in the recent past, for any 1% change in marginal cost, what is the impact on lending rate is what the banks are now supposed to find out, rather than basing their lending rate on an average duration cost. So average means historical, and historical, like very few, there's a very
so how often could it change for me if I'm a borrower, as a home loan borrower, for instance?
Well, it would change quite consistently. It'll change quite a few number of times, but
in a year,
and it'll be in your favor is what our expectations are, because right now short-term interest rates, short-term deposit rates are on a downswing, and this is going to have a positive impact on your EMIs, because the lending rates will keep on coming down.
Right. So if I were to put everything together, so we saw a cut in small savings rate, we are seeing a potential cut in interest rates, and we'll talk about that in a little bit, and we've seen this MCLR move. So if you were to put all this together, are we saying that we are entering a real, more friendly regime of?
I would think a definite environment is getting created for interest rates to nudge lower, to reflect what RBI had been had initiated right from Jan 2015.
Right. So from the time we saw the budget, we've been generally expecting, or industry has been expecting, a 50 basis points cut. Now you're obviously expecting a little lesser. So where do you think it's going to land on April 5th?
I think April 5th, we believe it's going to be 25 basis point rate cut. The reason being, monsoon outlook does become important after 2 years on trot of failed monsoon, and government, while did exceptionally well in food management, but the third year in a row will also mean that food inflation could pose some risks. Now we know that other components of fuel, namely fuel and core inflation, may not be as threatening,
right.
but food always has been the underpinning for risks as far as inflation trajectory is concerned. Now that's the reason we believe that the Reserve Bank may probably wait out, while we believe that another 25 is on cards sometime in the first half of the year.
But you're saying a monsoon signal is something
but
that
I think monsoon would be waited upon.
Debopam?
Well, my opinion would be 25 to 50, but I'll be more inclined towards 50.
On April 5th.
On April 5th,
right.
yes. The reason why I feel it will be more towards 50 is because I think the RBI will front load the cut in rates, and after that there will be no significant changes in the interest rate regime beyond that. Then the RBI governor will wait and watch how this FCLR plays out and how the transmission mechanism plays out, and there will be no further changes.
And you're saying that's what should ideally happen, not what you wish.
Yes, that's what should ideally happen.
Yeah.
There are three challenges in front of monetary policy makers right now in terms of stability. First is growth, obviously. Second is helping the banks come out of this NPA mess. And the third one is external sector. External sector, well, the global economy is in a slowdown and very little can be done unless people really take Dr. Rajan's feedback on having a comprehensive monetary policy of all the major economies together. However, the first two, growth and banks, is something which can be directly impacted right now. And growth is more important and followed by banks. And if growth is more important, then rate cuts is something that needs to be looked into.
Right. So, Shubhada, if we were to look at rate cuts, I mean, would this be one perhaps magic bullet to solve many of the problems that we are?
Well, we've always talked of interest rate is not the panacea to all ills. I mean, we have had to, wait for structural reforms for last 2 years. In the recent times, of course, the parliament session was more productive. But I think critical bills that would be waited upon would be the bankruptcy code. And what they was talking about, that, the NPL issues, I think it's more a holistic approach that needs to get adopted. Interest rate is one of the, factors that has to be addressed. But more importantly, I think once the bankruptcy code comes in, the banks will have more teeth to follow up in terms of, defaulters and so on. And that, to my mind, will aid significantly in cleansing the balance sheets of the banking sector.
Right. So, Debopam, let me come back to you on this. So, we've once upon a time seen a very low interest rate regime, maybe more than a decade ago. Are we likely to head there, or are we likely to stay in a world where interest rates will be relatively high and continue to remain high?
Well, basing our theories too much on history is not a clever thing to do at this stage, because if you look at the statements which are being released by Dr. Rajan or even Kaushik Basu in a recent interview, the chief economic advisor and the World Bank chief economist, everyone is prompting or asking the monetary policy makers to be much more open to experiments, because the world economy as well as the Indian economy is not any longer how it used to be, say 10 years, 15 years back in time. So maybe Keynesian
and what would you say is the significant difference?
Maybe a forced demand push by the government or the monetary policy makers is not the way out, because right now the slowdown that we see, especially in the industrial economies, is because of a debt overhang. So when the industrial economies were at their peak just before this last recession, they took a lot of loans, and now the debt repayment is causing all the problems that we see in the developed economies.
Right.
So that is something which I don't think Keynes foresaw, and the Keynesian theory does not tackle this pretty well. By giving a push to aggregate demand, you can pull up the economy. May not hold true in the current situation.
Right. So your view, Shubhada, on the role of interest rates and whether we can actually see them at a level where they...
I think the biggest problem that the globe has, most of the economies have today, is the question of elusive demand. I mean, where is the demand coming from, be it the developed economies or emerging markets and so on. And yes, some of the factors become very important, like excess leverage, etc. But I think the combination has to be played on. Unlike in India, where we are not really pushing for fisc because of the consolidated fiscal deficit issues, a lot of global thinking is also working on, it has to be, monetary policy has done its bit, but it's time perhaps to look at a composite approach, be it monetary or fiscal or structural reforms. The three have to work in tandem together to be able able to get out of the current kind of quagmire situation where you don't know where the demand has to be triggered from. Monetary policy overuse has blunted the instruments. If you notice, post G20, a lot of economies, developed economies which were flirting with negative interest rate regimes and pursuing it much further, have recently, in their recent pronouncements, seem to have stepped back a little bit and not aggressively, espousing the preference for negative interest rate policies.
But even if it were not negative and positive, the gap between India and the rest of the world is huge.
Definitely, but at the end of the day, what matters would be inflation story. India has a difficult task of getting to a 4% inflation, by 2018. I think the Reserve Bank would be, pretty much focused on the next step. 5 perhaps by 2017 is achievable, but for 4%, you need a combination of fiscal structural reforms and monetary policy.
Right. So, Debopam, what are you placing the most emphasis on? So, I'm assuming it's not monetary policy alone.
Absolutely not. But then I have certain amount of faith on our country's fiscal policy making process and monetary policy making process. If they were not sound enough, then we would not have been talking about a 7% growth even at this stage at this point of time, after having 2 consecutive droughts. So something is working in favor of us. Maybe it has to be sharpened a little bit more. There has to be a much more dialogue between the fiscal policy and the monetary policy, as ma'am was saying. But yes, we cannot be over-reliant on the monetary policy, yes.
Right. So, on April 5th, your last wish list, Shubhada, before we close?
50 can't be ruled out, but our base case is definitely 25 basis points.
And then you're also saying that announce a new liquidity framework?
Yes. We are anticipating a new liquidity framework to be set up.
Right, we've run out of time. Thank you so much.
Thank you.
That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.